So for our listeners who are investors and they aren't using private money like yet, can you explain how using private money is a win for you, even though it's a more expensive loan than some other things?
Yeah, great question because it is shell shock. Sometimes when you're looking at the interest rate, where it's like, you grow up thinking of interest rates and you're going to buy a regular house and you think, oh, it needs to be the same interest rate as if I was buying my own home. That's not true when it comes to private money lending and doing projects. Because of the time that's associated with the project, it makes sense most of the time to go ahead and pay the higher interest rate because you're using it for such a short amount of time. Of course, it
Right.
always goes back to the numbers. It always goes back to making sure you have enough margin in your deal to be able to pay the higher interest rate for that short amount of time. But really, when you look at it, if you're only borrowing the money for 6 months or 8 months or even 12 months sometimes, it still makes sense to pay the higher interest rate because of the ease of money. So when you're going through a traditional loan, the amount of paperwork is like giving your
Right.
firstborn child. And usually with private money and hard money, it's a more direct, here's what you need. It's attached to the project and you're done. Like you sign the paperwork. There's some background, of course. There's some processes that you have to go through, but it's a much easier process.
Right. And it allows you to do more deals, right? So even if you're paying, it was so funny because we did have this borrower once who was pushing back a lot on the interest rate for a loan. The whole reason she was because she had been quoted by some other lender a different, rate and term, but then of course they couldn't actually lend on the property. So she was trying to get that same term from us who we could actually lend on the property. You'll appreciate this, Julie. It's because it was rural. And as you know, most lenders really don't like rural. And
Yep.
it was like she was making such a big deal about it. And we did the calculation. I'm like, the difference in interest rate is $300.
Yeah.
$300
Yeah.
over the entire length of the loan. I hope $300 isn't making or breaking your deal, because
Any
if it
deal.
is, those margins are too thin, right?
And it is. It's crazy when you look at the numbers that way. It's not that big of a difference whenever you're looking at it. And especially the way you guys do it is awesome because you're able to put the interest rate, like we're not paying the full interest rate on the whole loan the whole time. So we're paying on how much we're taking as we're taking it.
Right.
So, for example, without giving actual numbers, like just as an example, like if you're borrowing 100,000, but you only need 20,000 for a month, and then you're doing the next renovations and you need another 20,000 for a month, that interest rate is only being charged on that 20 and then on that 20. Like it adds
Right.
up as it goes. But some loans, you're paying the full amount
Yes.
for the
whole
whole
time.
time that you have the loan.
Right. Yeah.
So-
And that's important to see those differences, because some people will do things, we got into lending as investors and people in the real estate space ourselves. A lot of people are brokers. They're just investors, right? They're not like in the sense of like they're just seeing this as a way to make money. And so they'll do things like they'll make the interest rate look lower up front to get, better marketing, to get more people in the door. But then, when you look at, like you said, all the nuances and the details, you're actually paying more overall because of how they change those terms.
Yeah.
Or the
And the
fees. A lot of lenders put on a ton of fees. It's crazy.
And
Okay.
those add up so quickly without even realizing it.
Yes. So thank you for humoring me and letting us go down that private lending journey for a while. I always love to talk about that. And it's great to have you on as, the other side of that equation. Now, when you're looking at these value add investing opportunities, these deals today, what are some non-negotiables that you really have realized as you've done some of these deals, you're like, oh my gosh, we got to look for this?
I have the eye of, oh my gosh, this could be amazing and we can make it beautiful and it's going to be all this. So we've bitten off more than we can chew sometimes, a couple of times before, where right now, actually, we're working on another historic property in Mobile. Another non-negotiable is really sticking to the numbers. There's been a couple of instances where it's like, I really want this property. And so then we are like, we get paid this much more. And it always bites us at the end because we've done the numbers. We know the numbers. And so that we've really tightened up on that we don't bend after we decide what the numbers are. That's what they are.
I love that. That is both of those great wisdom. Now I'm curious, because there's something we talked about a little bit here. Properties that would be classified as rural. I know that the property we worked on was that way. Can you maybe share your experience with rural properties and if that's something you would continue to do?
Yeah, we like the rural properties. Probably we grew up on a farm. So it's that background that we want to connect to it. So we like rural properties. The issue, or one of the big issues with rural properties, is finding lending. It is so hard to find a lender, and especially if you're going to use it as a short-term rental, as an Airbnb short-term rental. So you have to find the specific, on the refinance side, you have to find the specific lenders that will lend, first of all, rural, and then lend, second of all, as a short-term rental. So that's been difficult.